It's a pleasure to be here representing Onyx by JP Morgan. I'm going to talk about commercial bank money tokens, a topic that is very close to us and which we see as an evolution of the work we've been doing at Onyx. We have recently published a white paper jointly with Oliver Wyman, and this presentation is very much derived from this paper and our insights and findings. So let's move on to the, or rather I do it. Cool. So what is triggering the need for digital forms of money? We may debate, and we have been debating today very much the speed of change and progression, but there are two recognized trends. One, a drive towards tokenization, and two, again, as we discussed today, there is a need to improve cross-border payments. Firstly, tokenization. As estimated by BCG last year, tokenization of real-world assets may reach $16 trillion by 2030, which is a 50-fold increase, representing 10% of global GDP. And cross-border payments today need to become more efficient and less costly. We estimate that using digital forms of money, such as MCBDCs, can reduce costs by 80%. By extension, we estimate that commercial bank money tokens in digital form can replicate similar savings. So we believe that there is a need to develop and represent stable and scalable forms of money on the blockchain. This gap is currently being filled by stablecoins, but we believe a more scalable and more stable solution can be found in the form of commercial bank money, or as we call them, deposit tokens. And I will explain why we call them deposit tokens and not tokenized deposits. So what is a deposit token? Deposit token is a demand deposit claim against the issuing bank by the token holder. We believe a native token would be more efficient versus a non-native token. What do we mean by this? A native token is represented on the blockchain, where the blockchain is the ledger, as opposed to being a mirror of an off-chain platform. This is similar to the difference between a tokenized security, where the token represents a security off-chain, versus a native security token issued directly on the blockchain and recorded on the blockchain. Deposit tokens can be built against common token standards, such as ERC20. However, there is need to standardize the information needed to support the transfers. Furthermore, the tokens can be controlled to ensure validation of holders and screening of transfers. And again, today, there have been various discussions on these topics throughout with the use of verifiable credentials, etc. Now, let's turn to the evolution of blockchain infrastructures. At Onyx, we'd like to think of the evolution of blockchain infrastructure across mainly three types of ledger designs. This is certainly how we are developing our blockchain-based deposit solutions. An example of single bank ledger is our live product, JPM Coin system. JPM Coin is essentially a blockchain deposit account where JPM acts as its own ledger. It is not a stable coin. It's a regular bank deposit on a new form of technology. This deposit product currently helps our clients move US dollar funds across their own or participating accounts near real time on a 24/7 basis. This already brings a lot of efficiency and automation. In addition, blockchain deposit accounts are used as the cash leg for settlement of our intraday repo platform with live users today. Moving on to shared ledgers. Shared ledgers is when we expand beyond a single bank environment to a shared ledger environment. Again, we talked today about the need for interoperability and connectivity. This allows for multiple institutions to interact with each other using common standards on the same network. An example of this is Partior. Partior is an independent clearing and settlement platform funded by JP Morgan, DBS Bank, Temasek, and recently joined by Standard Chartered. It is essentially a peer-to-peer network which can support payment versus payment, delivery versus payment use cases, and also have potential to integrate with CBDCs and traditional payment rails, real-time payment rails. Moving on to universal ledgers. Universal ledgers are mostly public blockchains where interoperability is maximized. Now, having said that, of course, there is no single ledger. There are multiple public blockchains. But this type of environment requires regulated institutions like us to use controls to create a trust environment. This is what we demonstrated under Project Guardian last year under the supervision of Monetary Authority of Singapore. I'll talk a little bit about Project Guardian later through my presentation. The evolution that we outlined here doesn't mean that they cannot coexist together. In fact, the most realistic outcome is that these types of different ledger designs will continue to be present and potentially find ways to interoperate across the ledgers. So what are some of the use cases for deposit tokens? Deposit token is not really a new form of money, but it's the same money as bank deposits that sit on a different ledger. But it also embodies both the value and the payment rail in one. The use cases are across a broad set of categories where more instant and smarter way of moving funds peer-to-peer is possible. This reduces costs and also helps with liquidity management. In our white paper, we categorize these use cases across 6 broad pillars or concepts. For payments, a token form of money, as we said, essentially embodies the value and the payment rail in one, as opposed to our current structure where we have bank accounts, ledgers, and payment rails being separate. And of course, it's not just one payment rail, but it's multiple payment rails. So with the token form, you help transform payments from account to account versus peer-to-peer. Programmability. As a function of the smart contract, the deposit token can be programmed to follow certain algorithms to support further automation of transfers and conditional transfers of money. Protocol interaction. The tokens themselves are programmable, but there is also potential to interact with smart contract protocols for institutional applications, such as borrowing and lending. And this is really powerful when you have multiple entities, participants, and you need automated application of common rules. Of course, smart contracts protocols require reviews and audits to make sure any errors are corrected. This is in many ways similar to how banks run their multiple sophisticated systems today. Trading and settlement. As more assets from traditional securities to commodities and other assets are tokenized, we believe the need for on-chain native cash will increase. The simultaneous transfer of money versus asset can be established through what is called atomic settlement, if the cash and the asset are sitting on the same ledger. This supports DVP and PVP use cases where both legs of the transaction either fail or succeed. And lastly, collateral use cases. On-chain cash can support collateral use cases and help create faster access to liquidity and instant settlement, where collateral can move across use cases more seamlessly. So let me deep dive into one of these use cases, which we demonstrated under Project Guardian last year. And this was very much a sneak preview into what can happen and what is possible. So Project Guardian was born out of Monetary Authority of Singapore's desire to explore 4 topics with the industry: open interoperable networks, asset tokenization, trust anchors, and institutional-grade DeFi protocols. So under Project Guardian, JP Morgan issued Singapore dollar deposit tokens for an FX transaction opposite SBI on public blockchain Polygon. SBI issued a Japanese yen tokenized deposit, and these were traded in a cross-currency transaction. The tokens and the protocol used in the transaction were designed to restrict unknown parties from transacting with the tokens and the protocol. The deposit token smart contract required that only authorized parties could instruct transfers by attaching a verifiable credential developed by JP Morgan. So what the Project Guardian showed us is that even when we are enabling peer-to-peer transfers, as we did here, on public blockchain, we can still implement controls within the funds transfer process. Digital identity tools like verifiable credentials can support these transfers to ensure proper controls. Of course, we have to recognize this is a journey and several components need to come together. However, we believe this was important to demonstrate the possibility that we could develop towards these scenarios. So, all in all, when we wrote our paper, our intention was to elevate the awareness and the need for commercial bank money to be represented on blockchain and for its own unique features and characteristics. I think across the different types of digital forms of money, when we compare CBDCs, stablecoins, and commercial bank tokens, we need to make sure they are looked at their specific characteristics and their specific setup. For example, we believe that deposit tokens should not be confused with stablecoins, and they should not be part of the same regulatory framework. Deposit tokens can coexist along these other forms of digital money, and especially with CBDCs, there could be opportunities to use CBDCs, wholesale CBDCs, as the settlement layer. But other forms of settlement interoperability models can also exist, such as leveraging correspondent bank setups that exist today, leveraging existing payment RTGS systems, and other forms of interoperability, such as shared ledger that we talked about, can be the interoperability model for deposit tokens. I would like to finish with a quick overview of what we are doing at Onyx by JP Morgan. Onyx, as a business unit, was set up in 2020, but our history in blockchain goes further than that, even starting in 2015 when we launched our Blockchain Center of Excellence and we developed the quorum system. And under Onyx, we focus on re-architecting the way we process movement of information, money, and assets. And our blockchain deposit account solution, which I talked about, is live and helps move money across borders today. And our Onyx digital asset platform provides tokenization of assets that are used today for intraday repo and developing more applications. We are excited about the opportunities that deposit tokens can open up to achieve a faster, cheaper, and more transparent peer-to-peer economy. Thank you very much.
Thank you, Beşik. That's very interesting, and I think it'd be great to see what developments take place with tokenized deposits over the next few years. You mentioned central bank digital currencies there towards the end, and I was wondering if you could talk a little bit more about how you see interactions between tokenized deposits and deposit tokens and CBDCs.
Sure. So as I mentioned, I think, when we talk about deposit tokens, the immediate question is around interoperability, right? And we want to make sure there are paths for that, and there could be multiple options. And indeed, wholesale CBDCs could be a natural way to enable interoperability between bank movements. Of course, systemically important flows take place today at central bank accounts between banks and other institutions. So that is obviously one important aspect. But
that would be a wholesale CBDC, right?
Correct.
Just for the interbank settlement
yes,
layer.
Yes, wholesale CBDCs. And I think other options could be with regards to, for example, cross-border payments, shared ledgers, as I talked about, such as Partior, could be a way to facilitate interoperability. And in fact, there could be reliance on existing payment rails as well to facilitate settlement between banks.
Yeah. We've got a question from the virtual audience, and I'll open up the questions from the non-virtual, analog audience, whatever you guys are, in a moment. What challenges to the tokenization of deposits need to be addressed to build confidence in such systems? Do you feel like there will be a trust barrier to overcome?
Sure. There will be a natural process that we need to follow. If you look at the regulations today, there is no definition of a deposit token. So there needs to be recognition that this is an extension of a bank deposit product sitting on a new technical infrastructure. But also the token form itself, because it's different from account-based product, is also a novel point. So there is this aspect of how does this new form of bank deposit is recognized, similar to how bank deposits are recognized when account-based solutions are used. So that's one challenge. Yeah. And of course, interoperability and what happens when several banks issue their own deposit tokens, and how do they interoperate? So there needs to be platforms that bring banks together, such as we mentioned Partior or others. So those are things we need to overcome. But we believe there could be, smaller use cases where things can start. So in our own client base, we can have JP Morgan clients using deposit tokens to facilitate transactions. So that could start with that and then develop from there.
It's been mentioned a couple of times already today that the level of comfort, although CBDCs might have some unique values, the level of comfort that people have with commercial bank money is already very high, and replacing that with CBDC is probably not a big motivation for a lot of people. And in a sense, you've got less of a new, there's a new form factor, but it's a type of money that, broadly speaking, people are very comfortable with.
Yes, definitely. And I think perhaps because banks have been in the business of servicing clients and have other services to offer, it's more of a natural extension. But in my view, these forms of monies will coexist together.
You mentioned shared ledgers like Partior, and if you're looking at a settlement layer there, obviously there's a model for Partior, but can you talk a little bit about what the governance looks like? There has to be a body or a consortium or something like that setting the rules for that sort of thing. Is that going to be a challenge to build consensus if this is going to be a really widespread utility?
Sure, yes. I mean, consortiums are difficult to run, set up, make happen. And I think, banks move at different speeds. I think there are some aspects which there needs to be agreement or some standards, such as use of tokens, right? As I mentioned, ERC20 is one token form, but it's a pretty generic token form. What information needs to be included? and those are aspects that kind of, standards need to be formed to support, and of course, monitoring, and also the ledger itself. When you look at bank ledgers are typically, in-house, provided by the bank itself, and then, if you look at this concept of tokens being issued on other ledgers, what does that mean? Can that still be considered recording the master record of the tokens? Sure. So these are, some of the questions that are out there.
Any questions from the room? Yeah, one over here. Thank you.
Hi there. Kiran Chidambaram from Tata Consultancy. What is your thinking in terms of coexistence of bank deposits, deposit tokens, and potentially CBDC from a technology integration perspective? And how do you convince your retail customer to use demand tokens, especially when it is not recognized or regulated?
Sure. Well, I must first of all say that we're only looking at institutional use cases rather than retail. But for institutional use cases, and I think the account-based deposits will continue to exist, and then for certain use cases, we think that institutions will use token form of deposit, for example, to facilitate DVP transactions, right, or PVP, and then they could keep token form in circulation for other use cases, or they could bring the money back to their accounts with a bank and continue from there. So certainly for institutions, we see specific use cases where token form of money can be useful for cross-border transactions and atomic settlement purposes. And also, for example, the German Banking Association is working on commercial bank money token use case for machine-to-machine payments. So they're also experimenting how tokens can be used automatically to move money from one machine wallet to another. So there are these specific use cases which I think tokens will be at least initially used.
A question from the virtual audience here from Andre at PwC. How close is JPM to offering cross-border and cross-entity functionality for moving cash around?
So we already have a cross-border, cross-entity functionality under our JPM Coin blockchain deposit accounts. They are available cross-border across different entities.
Yep. Possibly he's thinking cross-entity as in with another bank or?
With another bank. So multi-bank route for us is the Part2Your platform. So Part2Your platform is currently in development where we have DBS as well as Standard Chartered there. So that's in progress.
Any timeline? Is that
As I mentioned, it's in progress.
Yeah. Okay, great. Yes, thank you.
Thank you very much, Thibaut Pellet from Worldline. I had a question about your view on the future of deposit token, such like the GPM coin. Do you see like all the major banks in the world to issue their own deposit token in their own environment? Maybe do you see like to have the same but in a common platform or anything else?
Sure. I mean, I think this is quite an investment to support these structures. So I imagine similar to correspondent bank models, right? I think banks may rely on each other to provide this form of money. So a bank may want to use JP Morgan deposit token for their customers to use JP Morgan deposit token. Again, similar to some of the money market fund structures as well. So it's not uncommon. So I don't think all banks will be issuing their own token form anytime soon. Over time, it may happen, but I think there will be options to get there through different models, such as correspondent bank type models.
Thank you. Yes, we've got one over there, I think, from hand was up before.
I have two questions. Just following up on the Partier, I know you said it's in development. Is it based on the Onx blockchain still, or is it using kind of a different underlying one, or is that public? I'm just curious.
Sorry, what was the?
Sorry, one more.
You said the Partier platform that you're building.
Yes.
I'm just curious, what's the underlying blockchain that you're being used on that? That was my first question.
Yes, EVM compatible blockchain. Yes,
Okay.
it's a private network.
Okay. And then my second question, so when I first read the deposit token kind of paper that you put out, it does seem like it's more of a play on obviously the commercial money bank. So it's really pitting kind of stable coins versus, or what we've kind of talked about as USDC kind of public stable coins versus the deposit tokens. But there's a question, so I'm curious just to get your thoughts on, there's kind of been a thinking of wanting to expand kind of players on bringing more fintechs into potentially under financial regulation. So there's questions mark, will Circle eventually come under financial regulation and not? I know the New York Fed and Swiss Bankers Association have kind of thrown their weight behind deposit tokens, but how do you see that kind of further evolving? Like, do you see it kind of, because we have instances of private issued stable coins right now by like the Australian National Bank and others. So I'm just trying to parse like that distinction between like public stable coins like USDC, kind of the private issued stable coins that we've seen, and then the concept of deposit tokens.
Yes, yeah. That's right. So in some markets, such as Australia and Japan as well, there's some work to issue bank-issued stablecoin that's one-to-one backed, issued by banks. So definitely the landscape has different forms evolving. So we are advocating for deposit tokens that are under the same depository framework as other bank deposit types. So it's not one-to-one backed, but we rely on our existing minimum reserve requirements, liquidity requirements. So that's the model we are advocating. And then there are the other aspects of course, will they be interest bearing? Will there be deposit insurance? Again, we would advocate that they should be able to pay interest and be subject to deposit insurance. So certainly, some of these different forms need to, and I think they will continue to exist. I mean, one thing that's kind of maybe interesting, when we look at stable coins, they are bearer tokens as opposed to some of the other models where non-bearer tokens are being advocated, and I think there are benefits of bearer tokens in a trusted environment where tokens can be held by non-customers of a bank, provided that there is there is a KYC framework agreed.
Just got time for one final question. We had one from the middle in the back there, I think. Yeah.
Mike Kanovitz with Jurat. You mentioned that JPM felt it was important that the token be a native currency of a blockchain, which suggests that it's proprietary or at least initiated by JPM. But then I noticed later in the slides you were forecasting JPM coins on public blockchains. So I wanted to understand what is the infrastructure or relationships or what the magic is that gets it from one to the other.
Yes, yeah, and this is an interesting topic around definitions of native, and there is a specific point that we make about native. So when we say kind of native token, we mean that wherever we issue it is the master ledger. So we are not reconciling against something else, like a off-chain balance sheet. So because that's inefficient, right? So we should be able to take a ledger, and that could be a private network that is not JPM's network, right? So JPM tokens may be available on a private permissioned network, or in fact, as we demonstrated at some point, a public blockchain environment, provided all these tools and monitoring and KYC questions, et cetera, are solved.
Yeah. We'll have to leave it there. Thank you, Beshek. It's a super interesting topic, and thank you for taking the questions. We've got a short break now, so help yourself to some tea and coffee, and then we'll be back at 4 for a session on cross-border payments with Ripple, RTGS Global, the IMF, Bank of Mauritius, and Katie Ann from the DMI.